Welcome to this explainer. Look, if you're a business owner or an HR leader, you probably know that creeping feeling of dread that surrounds the annual healthcare renewal cycle. It's frustrating, it's incredibly reactive, and frankly, it usually feels entirely out of your control. Well, my goal today is to help you escape that cycle. We're going to demystify the world of Affordable Care Act, or ACA, alternatives for your company's healthcare, and I'm going to show you how to actually regain control of your benefits and your budget.
Because let's be honest, here's the reality most of you are facing right now. You've got a relatively young, perfectly healthy workforce. Your claims are incredibly low, your headcount is completely stable, and yet you open up your renewal notice and see a 15 to 25% premium increase just staring right back at you. And the worst part? There is zero logical explanation. Sound familiar? I mean, why on earth are your costs rising when your team isn't actually using that much healthcare? It's maddening, and it's exactly why businesses start searching for a better way.
Okay, let's dive into this. Here is our roadmap for today. We're going to break down this complex landscape of acronyms into a clear, actionable strategy. We'll cover 1. The fully insured problem, 2. The master overview, 3. Meet level funded plans, 4. Self-funding and stop-loss, 5. ICHRA versus QSEHRA, and finally, 6. Long-term strategy.
Section 1. The fully insured problem. First things first, we need to identify the invisible villain that's quietly draining your bottom line month after month. The fundamental issue here is what we call the bundle. You see, in a traditional fully insured group plan, your premium combines your actual claims costs, the administrative operations, and the carrier's risk margin and profit, all rolled into one completely opaque, fixed number. It's basically a black box. You literally cannot see where the money goes. And here's the kicker. If your healthy team uses less healthcare than you actually paid for, you don't get a refund. You're essentially paying a high, inflexible premium that extracts your surplus and turns it directly into carrier profit. You are subsidizing a broader risk pool rather than just paying for your own actual workforce.
Section 2. The master overview. But the good news? You don't have to stay stuck in that model. You can break free by shifting how you handle risk and reward. Now, what's really interesting here is how this sliding scale of risk versus reward works across the different funding models. On one end, you have the status quo, the fully insured plan, zero claims transparency and absolutely no surplus potential. But as you move toward level-funded and self-funded plans, notice the shift. Claims transparency goes up, and suddenly you have the potential to keep that surplus if your claims are low. Then, over on the right, you have ICHRA and QSEHRA, which remove the traditional group dynamic entirely. So the core question you've got to ask yourself is, how much risk are you willing to carry in exchange for total transparency and the chance to keep your own money? Section 3. Meet level-funded plans. For a lot of folks, this is the most accessible stepping stone for employers who want to move away from fully insured plans. It really hits the sweet spot for companies with 10 to 50 employees. Basically, level funding takes that opaque bundle we talked about earlier and unbundles it into 3 clear, transparent steps. First, an administrative fee. Second, a stop-loss insurance premium. And third, a monthly contribution to your very own claims fund. Now, you still pay a predictable fixed amount every month, so you keep that necessary budget stability. But here is the absolutely incredible part. If your employees' claims run below the balance of that claims fund at the end of the year, you can actually receive a surplus refund or renewal credit. You are finally rewarded financially for having a healthy team.
Section 4. Self-funding and stop-loss.
Now, if level funding is the stepping stone, self-funding is the ultimate level of control. It's typically meant for employers with 50 or more employees who are really ready to take the reins. So the crucial point is the incredible transparency and control self-funding provides. You pay claims directly from a dedicated fund, meaning you retain 100% of the surplus when claims run favorably. You gain maximum claims transparency, which allows for proactive cost management. Like, if you see pharmacy costs spiking, you can actively change your plan design to address it right then and there. Now, full disclosure, it's true that this requires compliance with ERISA, the Employee Retirement Income Security Act, meaning stricter federal reporting. And it demands active vendor selection, like picking a third-party administrator. But honestly, for the right-sized company, that financial control is absolutely worth it. I know exactly what you're thinking right now. Wait, what if someone gets incredibly sick and we get hit with $1 million claim? And that is exactly where stop-loss insurance comes in. It is the vital protection layer that caps your financial exposure. You can secure specific stop-loss to cap the cost of any individual high-cost claim and aggregate stop-loss to cap your total claims for the entire year. It literally acts as your ultimate safety net, ensuring that self-funding remains a smart, calculated strategy rather than an endless, terrifying financial risk. Section 5. ICHRA versus QSEHRA.
But what if you just want to get out of the group plan game altogether? Enter reimbursement models. Instead of buying a group plan, you give your employees a tax-free monthly allowance to go buy their own individual insurance. And this brilliantly illustrates two main paths. First, we have the Individual Coverage HRA, or ICHRA. It fits any size company, has no minimum participation rules, and you can even customize allowances based on employee classes, so offering different amounts to salaried versus hourly workers, for example. Then we have the Qualified Small Employer HRA, or QSEHRA, proving once again that the IRS is just terrible at naming things. This one is strictly for businesses under 50 full-time employees. It requires a uniform offering to everyone and has IRS annual contribution caps, but it provides a wonderfully simple route for microbusinesses and startups to offer real benefits without the headache of managing a group plan.
Section 6. Long-term strategy. All right, let's bring all these concepts together to look at the ultimate goal here. I want you to ask yourself this and really internalize it. If you had full, transparent access to your company's actual claims data right now, what cost-saving intelligence would it reveal? Think about it. Right now, under a fully insured plan, you're operating completely in the dark. You can't see if gaps in preventative care or maybe expensive out-of-network pharmacy choices are driving your costs up. You deserve actionable intelligence about your own healthcare spend, and that traditional bundled system simply will not give it to you. To wrap things up, our source material really hits the nail on the head with this quote. The most significant shift that ACA alternatives enable is the transition from an annual reactive renewal cycle to a multi-year proactive cost management strategy. By stepping out of that black box bundle, you take back control of your financial destiny. Year 1 builds your transparency, and by year 2 and 3, you're actively optimizing your plan based on real, tangible data. So as we finish this explainer, I want to leave you with this final thought. When renewal time comes around again next year, are you going to blindly accept another 20% increase just to pad a carrier's profit margin, or are you finally going to demand the data and keep the surplus for yourself? The choice is entirely yours.